I have a question for you, and I want you to be brutally, painfully honest with me.
Okay, I'm ready.
When you walk out to your mailbox, specifically in, say, late January, and you spot that specific envelope, the thick, heavy one from your homeowners association, what is your immediate physical reaction?
Oh, the thud in the
Yep.
mailbox.
Yes,
The one that signals the arrival of the annual financial report.
exactly that one. It
Yeah.
is usually stuffed with spreadsheets, printed in font size 8, and full of bold text telling you what you can and cannot do with your own patio.
Right.
Do you rush inside, pour yourself a nice glass of wine, and read every single footnote? Or do you do what I suspect 99% of the human population does?
Which is scan the bottom line to see if my monthly dues went up and then immediately file it in the recycling bin.
Precisely. It's usually a source of anxiety or, at best, just extreme boredom. It's dry, it's confusing, and frankly, it often feels like an invoice for services you don't even remember asking for.
I think that's the standard experience. Most people view their HOA financial report as a maintenance receipt.
Yeah, a receipt.
It's just a list of things that broke over the last 12 months and, how much it cost to fix them. It's a record of loss, usually.
Right. It's a reminder of where your money went. But today, we're doing something a little weird. We are taking that envelope out of the trash.
We are.
We're doing a deep dive into a specific stack of papers that might just be the exception to the rule. We're looking at the 2025 full-year annual report for a community called Watercolors at La Quinta.
It sounds incredibly niche, I know.
Mm.
A specific HOA in the California desert. But, stick with us on this.
Seriously, stick with us, because I actually read this thing. It was written by their treasurer, Daniel Steele, and dated January 27, 2026. And it didn't read like a receipt. It read like a strategy document. It read like a blueprint for how a neighborhood should actually be run. It was, dare I say it, gripping.
That's the perfect way to frame it. The reason we are dissecting this specific report isn't just to applaud one community in La Quinta. It's because this document, it serves as a masterclass. It shows the difference between a board that is simply maintaining a property, treading water, paying the bills, and a board that is actively fortifying it.
Fortifying, that's a strong word. It implies defense. It implies building a wall against something.
In a financial sense, that is exactly what they are doing. The core thesis of this report, the headline summary that you really need to understand, is that this association has reached its strongest financial position in its history.
In its history.
We are seeing record-setting reserve growth and a massive reduction in debt.
Which is rare. Usually, as a community gets older, the money gets tighter, things break, dues go up, people get angry.
Exactly. This is a turnaround story. But what makes it a deep dive is that if you just glance to the numbers without context, you might actually think they were in trouble.
Yeah, let's get into the numbers, because when I first opened this, I saw the operating funds line item, and I panicked a little on their behalf. Now, for you listening, let's clarify. Operating funds is basically the checking account, right? The money used to pay the daily bills.
Correct. That's the daily cash flow. The money for the landscaper, the water bill, the trash pickup.
So in 2024, Watercolors had about $78,000 in that checking account. But by the end of 2025, that number dropped to around $45,000.
Big drop.
That is a drop of over $32,000.
A significant chunk.
If my personal checking account dropped by 40% in 1 year, I am hitting the panic button. I'm canceling Netflix. I'm switching to generic brand cereal. Looking at that line alone, it looks like they're bleeding cash.
And this is where financial literacy becomes so important for homeowners.
You're right.
If you stop reading there, you panic. You think the HOA is mismanaging funds. But you have to look at where that money went.
Okay.
It didn't just disappear. It wasn't spent on a party. It was a strategic transfer.
So it wasn't a loss.
Not a penny of it.
Yeah.
What happened was a very deliberate maneuver by the board and treasurer, Daniel Steele. They looked at their operating account at the end of the year and realized they were just holding too much cash in a low-interest environment. They had a surplus sitting in a checking account that likely earns, what, 0 or very little interest.
So they had too much money just sitting in the wallet doing nothing.
Exactly. So they took $65,000 of that excess cash and permanently transferred it into the reserve fund.
Okay, let's pause and define that for a second, because I think people use these terms interchangeably. Reserve fund. How is that different from the operating fund?
Think of the operating fund as your wallet or your checking account. You use it for groceries, gas, the electric bill expenses that happen every month,
The day-to-day stuff.
the day-to-day. The reserve fund is your 401k or your long-term savings account for, say, a new roof or new car. It's the money you are legally required to set aside for major replacements down the road.
So they moved money from the checking account to the high-yield savings account.
Precisely. And that one move completely flipped the script.
Yeah.
Because of that transfer, their total reserve funds grew by 18% year over year.
18%.
We are talking about an increase of over $100,000 in a single year. Their reserves went from about $562,000 to over $664,000.
$664,000. That is a serious rainy day fund.
It's substantial, and it changes the whole asset versus liability equation for the community.
Yeah.
Because of that move, the total assets of the association grew by over $73,000.
Okay.
But here is the kicker. At the same time they were stuffing the savings account, they also reduced their liabilities by 22%.
So savings went up and debt went down.
Simultaneously. It is the golden ratio of financial health. Whether you are a Fortune 500 company or a small neighborhood, that is the chart you want to see.
It really highlights a psychological shift, doesn't it? I feel like most HOAs operate in survival mode. They are terrified of running out of cash for the water bill, so they hoard it in the checking account where it's safe, but, stagnant.
Stagnant.
But Watercolors seems to be operating with an investor mindset.
That's it. That is the key theme here. They aren't just paying bills, they are building a war chest. They're optimizing every dollar to make sure it's working as hard as possible.
Speaking of optimizing dollars, we have to talk about the utilities section.
Oh, yes.
Because if the operating fund drop was a fake out, this next number looks like a genuine typo.
You're looking at the bundled telecom line item?
I am, and I honestly thought I was misreading it. I was looking at the variance analysis, which is just fancy talk for what we spent versus what we thought we would spend.
Right.
In 2024, they spent about $2,400 on bundled telecom.
Right. A very modest sum, likely just a basic connection for the guardhouse or the clubhouse.
And then in 2025, that number explodes. It goes from $2,400 to over $76,000.
Whoa.
That is a 30-fold increase.
It's a massive spike. Visually, on a spreadsheet, it looks terrible.
If I am a homeowner skimming this report, I'm thinking, who left the phone off the hook calling Australia? Or did the board buy a satellite? How do you justify a $73,000 increase in a utility bill?
It does look alarming on the surface, but this is actually the crown jewel of their 2025 strategy.
Really?
This is the Spectrum Broadband and Streaming Television Program.
Okay, so walk us through this. Why do they spend $76,000 on cable? In an era where everyone is cutting the cord, that sounds like a waste of money.
Context is key here. Previously, that $2,400 was just paying for internet at the clubhouse. The residents were on their own. Every homeowner had to negotiate their own deal with Spectrum or whoever, paying retail prices.
We all know how painful that is. You get the introductory rate for 12 months, and then suddenly your bill jumps to $90 or $100 a month, and you have to spend 3 hours on the phone threatening to cancel just to get it lowered again.
Exactly. It's inefficient and frustrating. You have 149 homeowners all paying retail price for the same product. So the HOA decided to leverage the power of the group. They signed a bulk contract.
Like a union. Or like buying in bulk at Costco.
Exactly like Costco. If you buy one roll of paper towels, it's $3. If you buy the pallet, it's 50 cents a roll.
Okay.
The HOA bought the pallet.
Ah, okay.
Now, the association pays for internet and streaming TV for all 149 homes, plus the clubhouse. That is why the line item on the HOA budget skyrocketed. The HOA is now paying the bill that the homeowners used to pay individually.
Okay, so the HOA bill went up, but does that actually help the homeowner? Because technically, the homeowners are the HOA. They're paying for it either way through their dues.
It helps immensely. This is the ultimate value proposition. Even though that line item jumped by $73,000, the HOA actually forecasted this. They budgeted almost $79,000 for it.
So they were prepared.
So they came in under budget. But here is the money in the pocket metric that really matters. The report breaks down the savings for the homeowners.
I saw this part. It's staggering numbers.
For the 122 homeowners who already had Spectrum service, they saved a combined total of over $76,800.
Wait. Is that per year?
No. That is just in the last 7 months of 2025.
Wow. So in barely half a year, the residents kept $76,000 in their own pockets that would have otherwise gone to the cable company.
Yes. And if you project that out over the 5-year life of the contract, The residents are projected to save over $658,000 combined.
Over $500,000 staying in the community rather than going to a massive telecom corporation. That is the definition of economies of scale.
It is. It's collective bargaining power. Instead of 149 people paying retail, you have one entity paying wholesale. And there's a bonus for the association itself.
What's that?
Because the service is now part of the master agreement, the clubhouse internet and TV are now fee-waived.
So the clubhouse gets free internet.
Essentially. The HOA saves about $12,000 in clubhouse operating costs over the contract life.
So let me get this straight. The HOA budget looks higher on paper, which might scare some people who don't read the fine print.
Right.
But the actual humans living in the houses have an extra 60 or 70 bucks a month staying in their bank accounts.
Exactly. The report explicitly says that's extra money in the pockets of members to spend on everything, from groceries, healthcare, home improvements, travel, local retailers, even investments.
I love that. It's putting the money back where it belongs. It's rare to see an HOA board thinking about the residents' personal grocery budgets, but that's essentially what they did here.
It proves that an HOA can be a tool for leverage, not just a rule enforcement agency. Usually, an HOA is just there to tell you to paint your fence or hide your trash cans.
Right.
This HOA is essentially negotiating a pay raise for its members.
So we've got financial wizardry with the reserves moving that cash to savings. We've got a massive bulk internet deal that saves homeowners huge money. But we still have to talk about the actual property, the stuff you can see, the landscaping.
The green budget, as it were. Landscaping is almost always the largest single maintenance expense for a community like this, and Watercolors is no exception. They spent over $202,000 on landscaping in 2025.
That's a lot of grass cutting.
It is, but the report highlights a shift in how that money was spent. It wasn't just mow, blow, and go. There was a significant pivot toward infrastructure.
I noticed the line item for irrigation repairs. In 2024, they spent about $1,300. In 2025, over $10,500.
Big jump.
That's a huge jump. Did all the pipes burst at once?
No, and that's the important distinction. This wasn't reactive, it was proactive. The report calls it preventative irrigation maintenance. They also spent over $17,000 on capital projects related to irrigation infrastructure.
Okay, play devil's advocate for a second. If I'm a homeowner, why should I be happy that we spent 10 grand fixing pipes that weren't broken yet? Why not save that money?
Because of where they live, La Quinta, the desert. Water is expensive, and water damage is even more expensive. It's the difference between waiting for a flood to destroy a street or wash out a foundation and preventing the leak in the first place.
So it's risk mitigation?
Precisely. In the desert, the irrigation system is the lifeblood of the property, but it's also the biggest liability. By spending 10 grand now on valves and controllers and smart systems, they're likely saving 50 or 100 grand in emergency repairs later.
It's like changing the oil in your car.
Exactly. You pay 50 bucks now, so you don't pay 5,000 for a new engine later.
The concept of deferred maintenance is the villain in this story, isn't it?
It is the silent killer of property values. When boards try to keep dues artificially low by skipping these repairs, they're just racking up a debt that the future homeowners will have to pay. Watercolors paying it forward. They are kicking the can down the road.
And they didn't stop at irrigation. I see here they did street maintenance for $11,000, fences and gates for $7,000, pool and spa work for over $6,000.
They got a lot done. They were active. They weren't just sitting on the money. They were maintaining the asset.
And this brings us back to the central mystery of this deep dive. They did all this work, new irrigation, street repairs, pool upgrades, a huge cable contract, and they still managed to grow the bank account by 100 grand. How? Are they printing money in the clubhouse basement?
They aren't printing it, but they are certainly growing it. This is what I call the secret weapon of this report. It's the high-yield investing strategy.
We're back to that investor mindset.
Yes. The report mentions transitioning matured investments into U.S. Treasury bills.
T-bills. Okay, for the listener who fell asleep in Econ 101, remind us why T-bills are a big deal right now.
Well, T-bills are government debt. You lend the U.S. government money, and they pay you interest. Historically, they are considered one of the safest investments on Earth. For a long time, they paid almost zero interest. But in 2024 and 2025, interest rates were up. They were paying 4–5%.
So safe money was suddenly profitable money.
Exactly. And here is where most HOAs fail. They are lazy with their cash. They leave it in a standard bank savings account earning like 0.5% because it's easy. Watercolors move their money into T-bills.
And what was the payoff?
The reserve accounts generated $20,604 in interest income alone in 2025.
20 grand.
That is a 29% increase from the previous year.
20 grand. Just for having money in the bank.
Think about what that means for the budget. That isn't money coming from dues. That isn't money coming from fines. That is free money.
Huh.
The report notes that this interest income covered nearly 40% of the year's total reserve expenditures.
Wait, I want to make sure I heard that right. 40% of the money they spent on reserve projects, fixing the streets, the fences, the pools, was paid for by the interest they earned on their savings.
That is correct.
That is incredible efficiency. Basically, almost half of their projects were free because they managed their cash flow correctly.
It's like having a silent employee who works 24/7 generating cash to fix the fence. If you aren't doing this, you are leaving free money on the table.
And the report says they aren't stopping there. They have a strategy for 2026 called reladdering. What is that?
A ladder is a bond strategy. Instead of buying one big bond, you buy bonds that mature at different times, 3 months, 6 months, 12 months.
Okay.
As one matures and you get the cash back, you reinvest it at the current rate. It keeps the money liquid, meaning you can get to it if you need it, but it keeps capturing those high rates. It's a sophisticated strategy for a volunteer board.
It really is a machine. So they've got the machine running, the reserves are fat, the internet is cheap, the pipes are fixed. But here's the big question. So what? What is the end game? The report mentions a 2026 roadmap. What are they saving all this money for?
That's the question every homeowner should ask. Why are you hoarding my money? And the report is very clear about the goal. It describes a defensive surplus policy.
Sounds military again?
It is. They are defending against the biggest enemy of any homeowner.
Which is?
The special assessment.
Oof. The two scariest words in homeownership.
Exactly.
For those lucky enough not to know, a special assessment is when the HOA sends you a letter saying, hey, the roof caved in, we have no money, please write us a check for $5,000 by Tuesday.
Correct. It forces people to take out loans. It forces people to sell their homes. It kills property values. And the report notes that Watercolors La Quinta is closing in on its 20th anniversary.
Ah, the 20-year mark, that's when things start to get creaky.
In property years, 20 is middle age. Roads need resurfacing, roofs need attention, major machinery breaks down. This is the danger zone.
Right.
This is usually when communities hit a financial wall. They haven't saved enough, something big breaks, and they have to drop the hammer on the homeowners with a huge bill.
And Daniel Steele and the board are trying to make sure that never happens.
That is the mission. The plan is to continue contributing $6,000 a month to reserves. That's $72,000 a year in new principal.
Wow.
Plus, they are maintaining a high liquidity buffer. They have over $72,000 sitting in the BOC reserve account just for emergencies.
Just in case.
Just in case. And they are planning for $50,000 to $60,000 in typical annual projects without even touching the principal growth. They want to live off the interest and the contributions and keep the nest egg growing.
It's really impressive. It feels less like a volunteer board and more like a professionally managed pension fund.
Which is what it should be.
Yeah.
You have to remember, for most people, their home is their biggest financial asset. The HOA is the manager of that asset's environment.
That's a great point.
If the HOA fails, your home value fails. If the HOA is broke, your house is worth less.
So let's zoom out and summarize the vibe here. Watercolors La Quinta has moved from simple maintenance, just fixing what breaks, to strategic value enhancement.
That's the key takeaway. This report proves that an HOA should be run like a business. It focuses on concepts like asset allocation and return on investment.
Right.
Look at the Spectrum deal. That's pure ROI. Look at the T-bills. That's asset allocation. It's not just about collecting dues and yelling at people for leaving their trash cans out.
It's funny because usually paying an HOA fee feels like a tax. You resent it. But reading this report, hearing about the defensive surplus and the savings on internet, it almost feels like buying insurance or investing in a mutual fund.
It feels like financial protection. And that is incredibly rare in the world of community management.
It is rare. And that leads me to the thought I want to leave our listeners with today. We started this deep dive talking about that thick envelope in your mailbox.
The one you want to throw away.
If you walked out to your mailbox right now and you pulled out your own community's financial report, what would you see?
That is the provocative question.
Would you see a maintenance checklist, just a list of bills paid and grass cut? Would you see a shrinking savings account? Or would you see a wealth building strategy?
Mm-hmm.
Would you see a board that is actively trying to put money back in your pocket and protect you from that dreaded special assessment?
It's worth checking. Dig it out of the recycling bin, look at the interest income line, look at the operating fund, see if your money's working for you or just sitting there.
And if you don't like what you see,
Maybe it's time to run for treasurer.
there you go. Be the Danielle Steele of your own neighborhood.
Exactly. Take the blueprint and apply it.
That's all for our deep dive into the Watercolors La Quinta 2025 annual report, a surprising page-turner in the world of HOA finance. Thanks for listening, and we'll catch you on the next one.
Stay curious, everyone.